We're going to continue looking at the Drexel Hall department store example or stores example. But in this example, we're looking at closing store 3. So because store 3 currently has a negative responsibility margin, our management is thinking about closing it and focusing more on stores 1 and 2. So we've done some analysis and we believe that closing store 3 would cause sales at store 1 to increase by 60,000 and sales at store 2 to increase by 120,000. Closing store 3 is not expected to cause any change in common fixed costs. So we want to look at what is the overall effect of closing store 3. So first we have, what is our decrease in monthly sales if we close store 3? So we're going to have lost sales from store 3 being closed. So right now, store 3 has $600,000 in sales. We'll no longer have those $600,000 in sales. However, we're going to have increased sales in store 1 and 2. The total amount of that increase is 60,000 plus 120,000 or 180,000. So our net decrease in monthly sales equals 600,000 minus that 180,000 increase in the other stores. Overall, we're going to lose 420,000 in sales. That doesn't necessarily mean lost income, though. So now we want to look at any increase in contribution margin at those other two stores. So we're going to have increase in contribution margin at store 1 and store 2. So at store 1, our sales are going to increase by 60,000. So our increase in contribution margin is 60,000 times our contribution margin ratio of 38%. In store 2, we're going to increase sales by $120,000. So take that 120,000 times the contribution margin ratio for store 2, which is 37%. So we have a total increase in contribution margin for store 1 and store 2. We also have increase in income because store 3 is closed. So we have $6,000 for that because remember, store 3 had a negative $6,000 amount. So our expected increase is the sum of our increase in our contribution margins for store 1 and store 2 and our increase in total income because store 3 is no longer operating at a loss. So the expected increase in monthly operating income for the entire company from closure of store 3 is $73,200. So under this example, we should consider closing store 3. We're also going to look at some CVP analysis for these stores. So it's the same stores, stores 1, 2, and 3 for Drexel Hall. In this analysis, we're considering two alternative advertising strategies. Each advertising strategy would cost $15,000 per month. The first strategy is to advertise our brand, which is expected to increase sales at all stores by 5%. The other strategy is to emphasize the low prices at store 2, which is expected to increase monthly sales at store 2 by 150,000 and reduce sales in stores 1 and 3 by 30,000. So our first strategy, advertise brand name Drexel Hall. Okay. We're going to increase the contribution margin at all three stores by 5%, or increase sales by and our contribution margin by 5%. So in store 1, we're going to take our contribution margin times 5%. And for store 2, we will take store 2's contribution margin times 5%. And in store 3, we take store 3's contribution margin times 5%. So we have a total increase in contribution margin. Across all three stores for the company. Is $36,000. The monthly cost of advertising is $15,000. So our increase in monthly operations is our increase in contribution margin minus our increase in cost, or $21,000. The second option is to advertise store 2. So we're going to look at the increase and decrease in contribution margin for each store. We're going to increase the contribution margin in store 2, but decrease in store 1 and 3. So in store 1, we're going to decrease sales by 30,000. So we'll want to put a negative 30,000 because it's a decrease, times our contribution margin ratio for store 1. Store 2 is going to increase sales by 150,000. So we're going to take 150,000 times our contribution margin ratio for store 2. And store 3 is also going to have a negative 30,000 in sales times the contribution margin for store 3. So the total change in monthly contribution margin across the organization, if we add all those together, is $30,600. We're going to have a monthly cost of advertising of $15,000. So our increase in monthly operations $30,600 minus $15,000 is $15,600. So out of the two options, advertising the store brand and increasing sales in all three stores is the best option. The last example that we have in chapter 22 is about transfer pricing. So if you remember from the chapter 2 lecture and the Learn Smart information, PowerPoint, transfer pricing is used when we have different divisions in our company that are transferring goods from one location to another. In this example, we have an operating division in the United Kingdom and an operating division in Mexico. So the Mexican division produces a component part used in the production process of the UK division. So we have transfer pricing. We can either have a negotiated transfer price that all managers have agreed upon, or we can use the market rate for a transfer price. We can also use a cost plus rate for transfer costing, where we take cost plus a markup percentage. So in this example, we're trying to decide whether we should use the negotiated rate of £700,000 or the market rate of £800,000. So we're going to compare the two. When we're trying to decide which transfer pricing is best for the company, it is the one that gives us the biggest tax advantage. So we have to look at the tax implications for these different options. So we're going to build a small income statement for the division and look at these examples. So we have the UK division has revenue amounting to £1.6 million. And the Mexican division has, this is the negotiated transfer rate, so that is £700,000. Now, when we're looking at sales for the entire company, we only want the sales to the outside. We don't want to record any sales revenues for transfer prices within our organization. Those are not shown in our financial statements. We do have to have a disclosure in our notes, but we don't show the actual transfer pricing. So our outside sales is that $1.6 million. Okay. For operating expenses, it says that we have 250,000 in operating or pounds for the Mexican division and 400,000 for the UK division. This is a total of 650,000 in operating expenses for the entire division. The cost of goods transferred is what the UK division records as cost for the goods that it receives from the Mexican division. So that is 700,000. Those are only recorded by the UK division, those costs. This gives us the taxable income for each division, which is sales minus the expenses. So we have taxable income for each of our divisions. Then we have that the marginal tax rate is 28% for the Mexico division and 25% for the UK. So 28% tax and 25% tax. We take the taxable income for each division times the tax rate, and we get the tax liability from that division's income. Add those together, and that gives us the tax liability for the entire organization. Then we're going to look at what are our options using the market transfer rate. Well, we have all of this same information here. The only thing that changes is that our rate is now 800,000 and our cost is 800,000. So that changes the tax liability for each organization. It decreases the tax liability for the UK division and increases the tax liability for the Mexican division. However, the entire company's tax liability goes up as a whole. So the transfer rate that is most beneficial to the company is the $700,000 negotiated transfer rate because it gives the company a lower tax liability.